Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for January 28th of 2024. Start off the chart pack this week with a few charts coming out of Crestmont Research that I thought were really interesting. Gives us a lot of historical perspective, and we're going to start off with one here that shows you the rolling stock market return over a 10-year rolling period going all the way back to 1909. And what it tells us very clearly is that there are ups and downs, even over 10 years, which tends to smooth out averages, so to speak. And you can see here that very, very, very seldom are there years in which you have a negative rolling 10-year return, and one of which occurred in the Great Depression, and the other one in the Great Recession and global financial crisis there in 2008. And and the average return across all time periods is around 10%. So 10% on a rolling 10-year basis. And this is what forms really the bedrock of some of our financial planning assumptions, is that over a long horizon, again, if you have the diligence and the intestinal fortitude to not cave to behavioral biases, and you're very consistent with your investment approach according to your investment policy statement, that you're apt to achieve, at least from the equity side of the coin, about a 10% return. So, but it does vary from time to time, and you can see the oscillation here very clearly. And just something we want to start off the pack with this week. Got a couple of charts that follow this up, also from Crestmont, which I think are really, really illustrative. This chart, rather colorful chart, it shows you kind of how the derivation of market returns looks like. And, returns can come from a lot of different things. There's dividend yields, there's valuation increases, and there's also earnings that play into that as well. And you can see, again, going back to 1909, which is a very interesting time frame in which we're looking at essentially 115 years almost of data, and you can see that for a long time dividends were very, very robust, and you bought stocks for their dividends, and that was a key component of investing in the stock market. Now it still is, but not nearly as much as it was. Now you tend to see valuation swings in the market. So you tend to see, earnings multiple increases, like price to earnings multiple increases following periods where you've had price to earnings multiple contraction. And you can see how that's oscillated over the years. And so, where we sit now is in a time frame where we've had strong earnings growth. And you can see the contribution of earnings to total 10-year rolling stock market returns. And that's really picked up, since, after, I guess, call it kind of the post-Great Depression period, all the way through the present. So earnings are very important, perhaps a little bit more so than dividends. But you can see that we're coming off of a market, or that we're in a market right now that's experienced multiple expansion. And so, we want to be careful about not overthinking this, but you can see that, sometimes when you get long extended periods of multiple expansion, you then get periods where the multiple is not expanding or maybe even decreasing. The final chart of the Crestmont pack here is just something that, that I pay attention to, because history is a guide. It's not an absolute. You can't take this to the bank, so to speak. But just looking at it from where we are, again, looking over 10-year rolling returns, and going again back to 1909, and you can see here that the annualized return is around 10% for the stock market. Again, diversified portfolios are also going to have fixed income, and so your blended returns are going to be obviously less than 10%. But where we are now, you tend to have when you start off a 10-year period at a high multiple, you tend to have lower overall 10-year rolling returns looking forward. And so that is actually kind of where we're at now. And so when you hear pundits talk about, well, the expected return in the stock market is likely to be less over maybe the next 3 to 5 to 8 years or something like that, they're kind of looking at this. And so, where we are now on a starting year price to earnings ratio is obviously higher than it has been, and it has gone up because a lot of the returns over the last couple of years have been driven by multiple expansion. And so, again, this is not to say that we're going to not have good returns in the equity market. It's just that it tends to foreshadow a period where returns are going to be maybe a little bit less than what they have been over the next several years. And so we just want to be cognizant of that, continue to do our fundamental research, continue to find pockets of value, and allocate according to where that data tells us. We have some data from FactSet is reprinted in Morgan Stanley, and this just shows you that we have had some earnings revisions already, and it's actually been happening for a number of months where you go into a calendar quarter and the estimates have been ratcheted down, and then when you get to earnings reporting season, then the companies are tending to beat those estimates. And so the same thing is playing out here in fourth quarter earnings that are now being announced and have been over the last several weeks. And we still have really about another 10 days, if you will, of earnings before we really kind of trickle out, and then we start to look ahead towards first quarter earnings, which we'll get in April. But you can see here very clearly that for the S&P 500, not so much for the NASDAQ, which is interesting because tech earnings have actually been reasonably strong, but S&P 500 and small caps, we've seen consistent earnings downgrades over the last several months. Now, talking about multiples and earnings and yields and things like that, we've got a couple of charts here. We've got the S&P 500 forward earnings yield minus the 10-year treasury. I've shown this chart to you before, and so what this tells us, this is basically what they call the equity risk premium. And so earnings yield is just basically earnings of the index divided by the index price level, and then from that you subtract the 10-year treasury yield, and you can see right now that that's about 1%. And so the equity risk premium is very small. And so this is kind of an issue that what it breeds is you've got more risk averse investors that say, I don't want to be in the stock market right now. I'd rather be in fixed income because I'm not getting paid to take on the additional volatility of equities, and that's what that's telling you. And then over on the right hand side we have the dividend yield of the S&P 500 on a forward looking basis. Subtracting from that is also the 10-year treasury yield. And so you can see here very clearly too that has gone down. And so again, fixed income is a much more viable opportunity now than it was 2 years ago, even though interest rates may have moderated slightly, but there is a compelling case to be made for balancing portfolios and diversifying portfolios because fixed income is an alternative. This chart we have here is the GDP number. It was 3.1%. It was foreshadowed by the Atlanta Fed's GDP Now, which has done an excellent job of foreshadowing economic growth. And this is obviously better than expected. We thought maybe we'd see something closer to maybe 2%. For the quarter that is just ended. And so we'll get two more revisions of the fourth quarter economic growth data, but this is 3.1% annualized. And then you can see in the shaded bars, this is forecasts of Wall Street Journal survey of economists, and you can see that there's clearly an expectation that annualized growth is going to slow to about 1% here in the first quarter. Over the next several quarters, you're going to have much slower growth, and then when you get to 2025, apt to pick up with a normalized growth rate of about 2%. Now when we dig into the components of this, you can see here, 3.1% was the overall economic growth rate for 2023. You see that in the dotted line here in this chart. You can see the components of where the economic growth came from and where it did not. Obviously, net trade was certainly a benefit, as was inventory. So this is a fourth quarter X-ray into that fourth quarter number that I just showed you. But you can see government spending is really strong. Now we're going to talk about that. So there's apt to be a little bit of slowing in government spending. We know that there's apt to be some gridlock. Obviously, it's an election year and there's a lot of posturing right now. But if you can't get government to agree to spend and you don't have major stimulus programs or things like that because you have a divided Congress, and government spending is apt to not expand as it has been. So you get less benefit from that component of it. And government spending is a very important component of economic growth. But we have non-residential investment, includes inventories, and then you get consumption below that, and then obviously net exports. And so we know that spending has been strong, net consumption, and we know that inventories were actually a contributor into the last quarter numbers. But I've got a chart to show you here that says that inventories are running pretty hot right now, and so we're not apt to get a lot of follow-on benefit from inventory growth. And so, the combination of perhaps slower government spending as well as slower inventory accumulation is setting that stage for a slower overall economic growth rate here in the first quarter. Now we're going to take a quick look here, a chart that I've shown you a little bit more, but on the left-hand side, it's just simply a reiteration of what I've shown you in the past. We've got the average interest rate on U.S. Treasuries moving higher. That's not any surprise with the rise in interest rates. Federal interest payments, I've also shown that to you as well. I mean, we're getting closer to essentially $1 trillion of annual interest that is being paid on the federal debt, and we know that we're issuing more debt now to satisfy our spending proclivity. On the right-hand side, though, is the conundrum that we live in now. So usually you get an increase in government spending, you get an increase in government debt issuance when you're running high unemployment and you're running, you're running into recessions. And so what they call this that's being circled here is basically pro-cyclical deficits. And so they're running high deficits even when you have low unemployment. When you're at kind of almost targeted employment or full employment, you're still running pretty high deficits. And so what it does, obviously it juices your economy. And we have seen, just as we saw in that last chart, even the fourth quarter was still benefiting from government spending, a lot of it driven by stimulus from various measures, that have come to the fore over the last, 12 to 24 months. But, it's very odd for us to be running these pro-cyclical deficits at a time where the economy is doing well for the most part, some chinks in the armor there, but for the most part doing reasonably well, but that we also have a strong labor market, and that labor market's apt to remain fairly strong, but yet we have these deficits. And so this is that conundrum that's causing a tug of war amongst analysts saying, well, are we going to have a slowdown or are we not? Well, you've got countervailing forces where you could essentially argue on both sides of that. So I mentioned inventories. This is a chart from Gabe Cowell and Macrobon, and so you can see that we are running hot on inventories versus the trend line. So I look at this and I think, again, like I said 2 charts ago or thereabouts, that, I think inventory growth is going to slow, and that will squeeze economic growth to some degree. So this is this is a chart from some San Francisco Fed research that I was reading, and it's very consistent with the outlook out there. We had a stronger than expected fourth quarter economic growth rate, but it's expected to slow and then eventually hit kind of a terminal growth rate, looking out into even 2026 of around 2%. You can see the gyrations, and again, I kind of look at this as like 2017 to 2019, we were running about 2 to 3.5% economic growth, pretty steady Eddie, so to speak. And then, then we had this big rock thrown into the calm pond. And then we had a pretty meaningful yet short-term contraction in real GDP growth. And then we had a snapback that was even or just as virulent as the downturn. And so now we're rippling out, and so those ripples are kind of muting out over time. And so we're, going to term out more than likely, towards the end of this year and into next year, back to that kind of that 2% baseline growth rate. So I want to talk about inflation just for a couple minutes. Just a quick update here, nothing new. We see core personal consumption expenditures. We've got an annualized rate of change. If you look at it over the last year, this is something that is pretty well understood. We're about 3.6-ish over the trailing 12 months based on the most recently announced data. Now, if you compress that, and look at it, just over the last 6 months, but then you annualize it, then you're down actually below 2%. So again, inflation's coming down. A lot of people are saying this is the impetus that should be looked at by the Fed in determining whether they're going to lower rates. We've got, wages that are still somewhat high. We still have other components of the economy that are higher than where people would like. And then obviously we've got a strong labor market, and then we have other growth factors that we'll show you on down the line that seem to be trending up, that kind of offset the argument of, yes, we need rate declines. Well, our short-term interest rates are now above inflation to a fair degree, and that's a pretty tight environment overall if you're looking at it just from that standpoint. So as a result, with a strong economy and albeit with inflation coming down, the probability of a rate cut in March has really gone down. And right here we can see it's at 40% and it's continuing to trend lower. Hearing more people talk about maybe May or June being the first rate cut at that particular Fed meeting. I'm not so sure that it necessarily happens then either. I think the Fed is definitely on pause. They want to make sure in their minds that inflation is not going to re-accelerate. This is well-documented periods in history where that's happened. The most notable of which was back in the 1930s when the Fed completely, at that point, and it was a relatively young Fed, never been through anything like that before, but they eased off the accelerator, holding down inflation. And of course, inflation spiked back up, and then we had a follow-on recession. Obviously that's something that everybody wants to avoid. And so, I think the proof will be in the pudding as we get into March and April, what that visibility is going to look like. And we really do need a couple of additional months of data to kind of give us some kind of signaling as to when we might get a rate cut. More charts on inflation here and also on inflation expectations. And so, personal consumption expenditures, it's a different measure than consumer price index, CPI, but as we've talked about ad nauseum in these charts, the PCE number is what the Fed looks at, and you can see here that's coming down, expected to continue to decelerate, and then kind of term out at the 2% targeted level. And so that is the data on the left. On the right are expectations, and those are all coming in. Looking at basically, expectations kind of hovering around the the 2.75 to 3% range if you kind of average it all out, and then obviously that number is lower when you look out into 2025. So as we kind of conclude the conversation about interest rate movements and expectations, really I can point to the left side chart as being that catalyst for the rather resounding rally in the equity markets towards the end of last year. The expectation was that we're going to get more rate cuts coming around March. You can see really the growth in the equity market during the fourth quarter can largely be explained by the difference in that green line and the blue line. So there's a lot of optimism being built into those rate cuts right now. And I think, as I've said before, that if that does not play out like this chart would imply, that there's apt to be some volatility in the equity markets. So again, we're going to have to wait and see on that, but this is actually what's priced in right now as of January 16th. And I do think that with the probability of a March cut going down now to 40%, as we saw a few charts ago, I think this curve is going to shift ever more and perhaps not be as acutely downward sloping as it appears right now. On the right-hand side, we've got long-term rates, and it's a very interesting look because it overlays several different things that are very important to the economy. You see the 30-year fixed mortgage rate in the green line. That has clearly come down off its peak. If you're a borrower that was looking at towards the end of the third quarter, rates that were getting close to 8%, and now they're somewhere close to about 6 3/4 or something like that. Well, memories are short, and you almost consider that to be a bargain now. But you can see where that sits, and everything is indexed to that 10-year Treasury yield in the blue line. You can see that there's a very necessary and very obvious correlation between those two. But you can also see that kind of that staggered beige line, which is the federal funds rate, and you can see where the yield curve is inverted right now. That short-term rates are higher than long-term rates. And then you can see in that light blue line, corporate bond yields, investment grade corporate bond yields are also tracking that 10-year. But that federal funds rate is the one line here that doesn't go with the rest, so to speak. And I think this is one of the reasons why the market feels like it's necessary that we have rates that are lower, because we implicitly have kind of a tighter overall environment with those short-term rates being as high as they are relative to where all these other categories are. Now we want to talk about labor. We've mentioned quite a few times, just about every week, that the labor market may be slowing down, but it's still relatively strong. This is a chart from the Bureau of Labor Statistics that that clearly shows you how that's decelerating, and this has been going on for the better part of the last year and a half to 2 years now. So the monthly change, it's almost it kind of almost feels imperceptible because the data that's being reported, it's feel-good data. The feedback is consistently with the labor market is still relatively strong. But you can clearly see the last 2 years that it's been slowing all along the way, but it's been kind of like a crawl, so to speak. And you see that 6-month moving average in the blue line trending down, but then kind of maybe flatlining up. And so again, you look at this and you can see it, both as half empty glass or glass, half full, because you have a labor market that if it were to continue to trend down and you have outright job losses, that obviously would probably precipitate into a recession, but you don't necessarily see that. And you've actually had a couple of months now of stronger overall job data, which may give you some pause as to how much more of a downturn we're going to have in the overall labor. But as we'll get ready to see here in a second, we have labor participation that's down, and that should keep wages higher. We have unemployment claims. These are initial claims, and you've got the 4-week moving average of that particular data point. Just as we saw in that last chart where it looks like, jobs are slowing. You also have slowdown in claims too, and you've got, I think, companies that are kind of sitting on their hands. They're not necessarily saying, I want to lose these employees, I'm going to lay them off because it might be hard for me to go back and rehire them, especially if they have some form of specialized training. But at the same time, they're saying, well, listen, business isn't that bad that I need to necessarily go lay off people anyway. They're just not hiring at as rapid a pace as they were, and they're not posting available jobs at the same pace that they were not too long ago. Here we have the participation rate that I mentioned earlier. You can see that with the pandemic dislocation, we were on an uptrend, and then we kind of resumed that uptrend with kind of a reset with the whole COVID, work from home, people leaving the job workforce, wanting to focus on lifestyle type activities, but we've had participation pick up, but now we're seeing it roll over, and so I think this is consistent with the thinking that you're going to have sticky wages, because you have a lower growth rate in overall jobs, and you have participation that's rolling over to some degree as well. So on this chart, we overlay wages and salaries against prices. And so you can see here that you've got the PCE price index in gray. You can see that, as we have been noting, has been trending lower, just as CPI has. And so you're in that kind of like 3% to 3.5% ballpark. But then, in that blue line, you can see wage and salaries are actually, they were holding steady within a tight range now, around 5%, 5.5% to 6%. And they've actually gone back up. They've trended up. And I think it's a function of what I just described to you, is that we have labor force participation that has gone down a little bit. And the supply of new positions has slowed down quite a bit. And I think this is a point that we're going to have to pay attention to when we talk about the probability of rate cuts. So, with wages remaining relatively high, the job market overall remaining kind of sticky to some degree, that is going to be something the Fed's going to watch very, very closely, and wanting to avoid that, introducing that catalyst for reinflating the economy. Spend a few minutes now kind of talking about other aspects of the economy. Here we have the U.S. Purchasing Managers Index. So this is a diffusion index, so everything below 50 represents contraction. You can see that manufacturing has been in this rolling recession. So when you talk about not having been in an official overall economic recession, we know that manufacturing clearly has been in a recession, and currently in contraction right now, but showing a little bit of a leg up. We do see the services side of the economy, which was also in a recession, is sustained its growth. And we see the composite PMI here that's moving higher. But the takeaway from this is that manufacturing seems to be basing out and perhaps trending higher. And even though manufacturing is apt to be and continue to be a little bit sluggish over the coming months, it's increasingly looking better than it has been. So against a backdrop of a slowing economy here in the first quarter, or at least the expectations thereof, we have suppliers' delivery times, and right now they continue to erode. Whether you're in the U.S., the Eurozone, or in Britain, it's really the same story. And a lot of reasons why we've been trending lower for a few months now, but that has recently accelerated with the issues going on in the Persian Gulf. with the Red Sea and the Houthi rebels. They're causing a lot of havoc. We were already seeing some choke points in Panama, the Panama Canal with drought conditions there, necessarily reducing a lot of the volume there. But it's just exacerbating a situation that is already causing some choke points. And this is a bigger issue for Europe than it is for the U.S. But when you think about overall global economic growth, that this is something that we're going to have to contend with at least for the first, I'd say, the first 3-4 months of the year, and not sure what the eventual resolution is. We know what the rebels want, and that's complete odds with what Israel's willing to do at this point. So we'll just have to see. But I do think that as it pertains to economic growth, that it's supplier delivery times and supplier choke points that add cost into production and shipping that may weigh on overall profits here in the coming months. Well, and along the same lines here, we've got container prices that have really gone through the roof for all the obvious reasons. Most of the impact in the Red Sea is for container ships and obviously for oil tankers as well. But just the overall cost of this, insurers are really getting behind this and trying to mitigate their risk and reinsurance and so on and so forth. And they're raising their rates, and so all along the food chain, you're seeing in the shipping world an increase in cost. Talk about the Conference Board leading economic index for a minute. So you can see it here on the left-hand side. It's been negative for quite some time. In fact, 21 straight months. And this is something that by its rule of thumb would indicate that you're on the eve of a recession if you're not already in it. And so so we've been negative for 21 straight months. You can see the components or the contributors to LEI on the right-hand side. So inverted yield curve, lower consumer expectations, lower overall Institute for Supply Management new orders are all taking away. But then you see the stock market really leading the way on the upside, and so building permits are slightly higher. We're seeing that, and then credit, as we see, is actually, I'll call it, less bad than it was. And so the net of all of that is that we have a slight decrease, 0.1% in December, which is actually better than what the estimate was. And so if there is a silver lining to this, it's that the latest reading was actually almost flat. And again, if you're trying to search for little victories, you could probably look at that as being one. And that's not to say that it's positive or that we can take that to the bank, but at least the LEI is not as poor as it has been. However, looking at the LEI, it's never been this low for this long. Right-hand side, you can see that circle. I mean, there have been just very few cases where the LEI has been negative for this long, and you haven't had a recession. But again, we're dealing with this ripple effect from a pandemic economy that was shut down, and I think we're learning a lot about how that has made things very unusual. And I always hesitate before I start even inkling that this time might be different. But the circumstances behind an economic shutdown and then the stimulus, very artificially on both sides of that coin, very artificial. And I find it real interesting to see data like the LEI being negative for 21 months. And we're not in a recession, but I do think that the economy, we get to 2025, I think we're going to have all of this pandemic shockwave behind us, and we'll be in kind of what we would consider to be a normal pattern. Now, the question in 2024 is, are we going to have that recession that follows that economic slowness? And I think the preponderance of the data says no. But again, history is something that we have to, we have to take stock of and just and be prepared. And I do think policymakers are cognizant of this data, and they're filtering it through their decision mechanisms and making sure that that they're not losing sight of what history might otherwise suggest absent a pandemic. Now what we're looking at is the leading economic index, LEI, and GDP growth. And so here we have on the red line, we have the LEI, which we know has been negative, and this is a data series that goes all the way back to 1960, so that's why it seems fairly compressed. But so we've had 21 negative months in the LEI, and it was, as we saw, slightly negative in that last reading, but we have positive economic growth. And you can see very clearly when you have the LEI that goes down as much as it has, there's really been only one instance, and that was at the beginning of the century where you didn't have GDP go negative. And so the fact that GDP is almost re-accelerated and it was much better than expected in the fourth quarter is maybe one reason why that you would think that, okay, maybe in this instance the LEI is not as good of an indicator as it typically is or has been in the past. As we kind of get close to the end here, a couple of charts that I thought were very interesting. We see private equity, lots of dry powder. This is the same on the private credit side, and I've shown you some data on private credit over the last several weeks. And so, there's a lot of money that's been raised that is sitting ready to be deployed, and when you think about, economy that's slowing and, that there are going to be companies under stress for a variety of reasons, and, that there is a lot of dry capital, dry powder, so to speak, available to swoop in and help optimize and right-size those businesses that sits outside the traditional commercial banking sector. And in this case, we're looking at private equity, and so it's less of a lending situation than it is a takeover, optimization, and then a sell down the road to another buyer. And this is something you look at, and it makes you feel a lot better about the circumstances of getting through a slow period without having a recession. So we have China. We've been talking a lot about China. This is essentially residential projects. You can see new starts have really gone through the floor. I do think the emerging market sector is really cheap relative to the U.S. right now. And some of the reason for that is China. But if you can find exposure to emerging markets that doesn't have China in it, I do think that's a value. A value always needs a catalyst. But I do think the Chinese economy is in more of a pickle than we're hearing about from the Chinese government. We all know that they massage their statistics, or likely massage their statistics, but the official stats that they are releasing and their statements are giving a little bit of insight into, I think, the concern that they have right now. The last slide we have here was something I took particular interest in running through the data and the daily shot here, that something that we all know, but the degree to which it's happening is pretty interesting. We have people that are really shunning, as this title would suggest, brick and mortar retailers, department stores in favor of online sources. And that's something that we were well aware of, happening and maybe even accelerating during the pandemic. But this has all sorts of implications. There's lots of institutions that own department stores, that own retail. We know that banks are really persnickety right now on what they're lending on, and retail seems to be coming back, but certainly not in the department store format. It's in kind of this mixed use, kind of an urban shopping type product that's out there, and it's certainly not these large box retailers, and it will be interesting, even though there was a slight uptick in December, which may be more seasonal than anything else. But we'll have to see how this impacts like real estate credit, how it impacts certain types of real estate investments that own these facilities that house these department stores, and there's just quite a few implications here that we'll have to monitor. That's all we have for this week. Hope you have a great week, and we'll talk to you again soon. Take care. Bye.